everyone, it's Rich Tarani, the Tech Authority, and I am so excited today. I've got an amazing guest for us. He's Jules Walker. He's a managing director of the emerging technology practice at KPMG US. Jules, how are you?
Rich, good to see you, buddy. I don't know if we want to put this out up front, but we actually have known each other a long time. We literally grew up together many moons ago. So pleasure is mine. Good to see you, buddy.
You are the longest lasting, or definitely one of the top longest lasting relationships I've had that are now in the tech world, I would have to say, which is actually pretty amazing. That we're at the point right now where the other people that were in that select group are retiring, right?
Yeah, we're not going to talk about how many years ago we're talking about here, but yes, it's a pleasure to be here with you.
So I figured let's off the bat, let's talk about just what your company does, what you do. How do you help your clients? What do you guys do?
Yeah, so KPMG, for those that don't know, not a radio station. We are one of the big four accounting firms, global footprint, billions of dollars in revenue across the world. My little slice of it is I am a managing director. I lead a team of business development folks running our private enterprise business development efforts, which means I have a bunch of sales folks that work for me. And we focus on two different areas relevant to this conversation. On the one hand, half my team sells KPMG services and products into funds themselves, hedge funds, VC funds, PE funds, real estate funds. And the other half, which is also my day job, sells into the portfolio companies. So VC-backed, PE-backed portfolio companies are my focus on day in and day out. Once they get to public, I generally say, nice to know you. Let me hand off to my colleagues to help you going forward. But that's my world.
That's fantastic. And this is really an exciting time for us to be talking, right? Especially we're going to be talking about the state of the VC market. And, this is probably one of the biggest weeks, if not, I don't know, the biggest week that I remember in tech. It's such a big week that the news that gets no attention is that Apple is working with Starlink to allow satellite access to its phones. And I updated my iOS last night, and then I tested it from my bed to see if I had satellite access. Apparently, I do have satellite access from my bedroom, which is kind of cool. And so that's like the smallest news of the week, right? We've got AI models dropping from China like rain, right? It's unbelievable.
Yeah, I was thinking about it coming into this conversation, that if we had this conversation a week, 2 weeks ago, it's totally different. The amount of change that's happened both technologically and financially. I mean, just it's a footnote that NVIDIA lost the most market cap in a single day, the most of all time, any company in history on Monday when it dropped, I think, $600 billion market cap. There's just so many of those little nuances to this story this week that I'd love to get into it with you.
Yeah, and it's fascinating, right? Because if the one thing that we learned, it is that it's potentially possible, assuming everything that we've heard about DeepSeek, and that's the primary company we're talking about, if everything's accurate with what they've told us, they're 95% more efficient in their model training than what was necessary with OpenAI, meaning you look at it a couple of different ways. You can get to the same result spending 95% less money, or you're 20 times more efficient for every dollar you spend, right? So there's two, depending on which side you're on.
And I think that's what's still shaking out. It's been all of 48 hours really since the news came out, but everybody's trying to figure out, not that it's one or the other, but which side of the equation they're on. Some are looking, they're trying to punch holes into the announcement. Oh, they actually used a lot more compute power and it costs a lot more. One, two, they actually, I don't want to say stole, but they borrowed training from OpenAI versus their own. So that throws off that number a little bit. But arguably more important is the other side of it. Software companies in particular are saying, gosh, I don't need to spend that much anymore to build these agents that I want to build. We could do it a lot more efficiently, a lot faster. Maybe it's a smaller ultimate footprint, if you will, but the ability to build stuff and iterate and build flavor one, flavor two, flavor three, whereas before with the cost, it was just going to be flavor one. The possibilities are really endless and very exciting.
And so when we talked about having you on the program last week, none of this really had happened. So I was going to ask you, what are some of the surprising trends in the VC market, and how does it compare to prior quarters and prior years? I still want to know the answer, but what are your thoughts based upon the fact that the VCs are probably trying to figure it out as well, right?
Yeah, it's obviously a related answer. I mean, so trends are, and this is not just going back one quarter, this is going back 5 or 6 quarters. But in the VC world, everything is AI. It's funny. I talk to some startup. I talk to startups all the time. I do a lot of mentoring in my role, and the ones that don't slap a .ai on the end of their name, those are the ones that I question. Like, oh, what are you guys doing? Why aren't you doing AI? So everything's AI, and I really feel bad for companies that can't do the .ai. Just it doesn't make sense. It's food tech or ag tech or something like that. Even the ag tech ones could do a .ai, but AI is still dominating in the investment space, and I love VCs. I think they're some of the smartest people I know. But as a group, there's a lot of FOMO, a lot of lemming activity. Whereas, Sequoia and Andreessen invested in this company, therefore I got to get in. Valuation be damned. And so that's been a trend over the last couple quarters. And companies that are outside of that space have had a hard time raising. And we'll get into it a little bit more about some other trends, but there's really certain boxes you got to check now as a company raising money that you didn't have to 2-3 years ago. Whether it comes to line of sight on profitability, growth, of course, is always, but are you efficient in how you're using your money? That wasn't brought up before. Before it was grow at any cost, add eyeballs. And now it's like, well, are we adding eyeballs the right way? So that's been a trend over time.
And I should mention that your company put out a Q4 Venture Pulse report, US, on just the state of VC, which is really, and you were quoted in it, and this really triggered me reaching out. So people should go to your site and kpmg.com and just look this up if they're interested in learning more. It's another question that I thought of last week, which is it's amazing how all these things have changed just over the course of a weekend. Is what are the consequences of geopolitical and macroeconomic factors? And since I came up with this question, we've had migrants going back to Colombia saying no, tariffs applied. The price of coffee theoretically was going to go up, and we were not going to get our Valentine's Day flowers. Everyone freaked out about that. Then the tariffs went away. Colombia took the migrants, and so now there's no tariffs. But it just shows, this past weekend was pretty crazy, not just from a tech standpoint, but also macroeconomic, geopolitical. How do you see that playing in with VC investment?
So first of all, thanks for the plug for the Venture Pulse report. It is a quarterly report. We've been doing it, I think, for 10 years now. So every quarter for the last 10 years. And it's pretty comprehensive, domestic and international, as far as trends and what's going on in the market. Geopolitical wise, the big kahuna subject matter was the U.S. election. And it was all the buildup until that, and things weren't really getting done until we knew who was going to be sitting in the White House. And now the last couple months, it's what does Trump mean for the U.S., for tech, for business, for finance, for the world? And it's been pretty impressive with the amount of saber rattling he's been doing, financial saber rattling over the last only a week now that he's officially been in office, week and a couple days. I think it's all still a lot of TBD. So we know he's in there. He's expressed what he wants to do, and tariffs is front and center. Seems to be his favorite tool to manipulate almost anything geopolitically. It's going to be interesting to see how that plays out. But that's a big driver, and it still is a bit of an unknown, even though it feels like, okay, we got the answer to the question of who's going to sit in the White House. But now it's like, is he really going to do all that? The Colombia thing was interesting just because they kind of pushed back, and he immediately stomped on them because it's a small country and it needs to export goods to the U.S. It's going to be fascinating how this goes forward internally, but arguably externally more interesting with tariffs. The people he has around him, from Elon to David Sachs, the AI czar, in his ear. I'm fascinated to see how things play out.
Yeah, David Sachs is certainly one of the most knowledgeable and I'd say clear-headed thinking people in the world of VC, having also been an entrepreneur, a serial entrepreneur, successful himself, and the fact that he's bringing that knowledge to the world of just the regulatory regime of AI and crypto. I think it's going to be very helpful because we're going to see very thoughtful, hopefully, very thoughtful policies. Because it is government after all, but assuming things can be rolled out in a way that are coming from some of these entrepreneurial leaders that are working with Trump, I think we'll be in really good shape. I know there tends to be bloat when you have a regulatory environment, right? You look at the tax code, right? It's like 70,000 pages, but if they can do it in a clear-headed way, I think we're in good shape and good standing. And another interesting scenario here is this question that I have on the sectors. What do you think is going to be the hot sector going forward? What were the hot sectors? Is that going to change? Is the DeepSeek news going to change things? Will the sector still be just as hot that were hot that you thought they would be hot last week? They're going to be hot next week, etc.
Yeah. So on the sector front, again, different conversation if we had met 2 weeks ago. I still think AI is front and center and is going to continue to be the primary recipient as a group of VC money over the next couple quarters. But I think we're going to the next level. It's not necessarily a pivot point, but as we talked about at the top of the show, it's now the application of that AI. And if it really is a less expensive option with DeepSeek, then what are people doing with it? What are companies doing with it? Specifically on the software side, specifically on the agent side. I think that's going to be the future quarters, what we're going to see from an investment perspective. Outside of that, and everything's kind of related. Again, everything is related to AI, but spaces like robotics, different functions, different form factors of robots is getting a lot of money, and we're seeing it in action. If you go to a Tesla plant, if you go to an Amazon warehouse, you're going to see robots in action. And the disturbing part is that many of the roles that they're playing were humans before, and now it takes just a handful of humans to run a whole warehouse of robots. That train has left the station. And then there's all kinds of different applications on robotics. The other one that again is related to AI, but plays into the administration changes, defense tech. Many companies are making software, they're making drones, they're making border implementations, walls and such. Defense tech is a huge business now, and it's just going to keep growing. Unfortunately, that's not necessarily US only. It's global. We have more wars going on right now. So it's a pretty target rich environment, excuse the pun, for investment as an industry. So we're going to see more of that. Those are the two I wanted to call out in particular. Actually, a third one, food tech, ag tech is an area that I am interested in. I just think, and it plays into the robotics too. There are robots out in the fields now that are planting seeds, that are spreading fertilizer, managing, picking. I mean, so it actually ties in a little bit. If we get rid of many of the immigrants, those are a lot of the people that were out picking strawberries out in the field, and we love them for that. If we can transition from that to robotics, that might be the stopgap or the solution for that particular industry. If we really do lose millions of people due to the immigration policy, so it all really ties in together. It's fascinating, and I'm interested to watch it. I'm a little skeptical. I'm a little nervous, but interested to see how it all plays out.
Yeah, those are really good points. I think, look, the reality is that the train has left the station, like you said. The jobs that were around in the last few years, in 10 years, there will most likely not be job of truck driver. There will most likely not be job of Uber driver, delivery person, etc. There are a lot of these things that are going to get replaced by robotics. The more farm agricultural jobs are going to get replaced as well by robots and autonomous vehicles. So you kind of the fact that we're having, let's say, the people that do a lot of these jobs leaving the country is in a way it's going to be good because in 5 years these jobs are not going to exist here. They may exist in other parts of the world because they're going to be slower to automate, right? So if anything, the jobs are going to the lower level jobs that are, I could say, more manual labor are going to probably remain for a while in third world countries, and first world are going to deploy this tech, and so we'll see. We'll see how this plays out. But that's how I see things, and that actually gets me to the next question. If you look at the different regions, where are you seeing investment? Asia, Europe, U.S. Like, are you seeing different trends? South America, etc.
So I sit in Silicon Valley, and we're a little pompous here, admittedly, but Silicon Valley remains, call it 10 years ahead of any other market. You could pick your number. Uh, I'll say 10 years ahead. And I would put that 10 years ahead of New York, LA, Boston, the US markets. And when I say ahead, I mean the amount of investment, the amount of entrepreneurs, the amount of companies getting churned out globally. And it's a broad swath to say this about the whole rest of the world. But the rest of the world is another 10 years behind those secondary US markets. And again, what I mean by that is the comfort with writing checks. A lot of countries have cultures where the idea of failure is horrible. It's a strike on your family's name if I failed as an entrepreneur in some other countries. Whereas in Silicon Valley, it's a badge of honor. Like you put that one top of your resume, top of your LinkedIn. I had 3 startups, 2 failed, 1 got acquired. So I think that's changing. It's a mindset that's starting to change. The money is growing in those other markets. The cross-border funding, whether it's US VCs investing overseas or just homegrown investors developing. I don't think the check sizes are going to get to the point of where they are in the US for many, many years. 10 years, I think. But it's coming. And there's one-offs, right? There's Mistral in France that raised a lot of money, AI. There's Cohere in Canada, raised a lot of money, AI. So there's exceptions. And in this case, the exception is the industry of AI. But all those other markets that want to be like Silicon Valley, it's still a long ways to go, but they have their eye on the prize and they're moving that direction.
Yeah, and you've also, it's interesting, states too. Other states like we know cities and states are trying to compete with Silicon Valley, right? You've got Austin, you've got Miami, you've got New York that are vying to get a piece of that pie. So a lot of competition for venues, and of course Europe right now. The big challenge, if you're on Twitter X and you follow what's going on there, you know the joke is that America innovates, China copies, and Europe regulates. Right, their biggest accomplishment. The If you look at the memes on Twitter, the biggest accomplishment is that connected plastic cap to the water bottle, which, for those of you that might have vacationed in Italy like myself this past year, makes drinking water a lot less enjoyable. But anyway, the point is that they're regulating, and that is not helping their tech community. And in the U.S., hopefully, we're going to have even less regulations in the next few years that will make it even easier for companies to get started and to prosper. And like you mentioned, in China, there was an article maybe a month ago about how those people who failed now they're liable, right? Their social credit score for bankruptcy, and so it's a totally different world than in Silicon Valley, where the badge of honor is not a badge of honor; it's a badge of shame. And so that's something that that's a cultural thing, right? So we'll see if the world changes in terms of being more like Silicon Valley. They're going to have to if they want to compete. And that gets me to the next question in terms of, badge of shame, but badge of honor. A lot of the companies that were funded, let's say, prior to March 2022, were in a different environment, right? There was, at that time, valuations were higher, interest rates were lower, and money was really flowing. and some of them have runway till now, or some of them haven't had to raise, and they're now trying to figure out what to do. And even those that have raised in the last couple of years, the expectations of VCs and the expectations and the actual behavior of entrepreneurs has had to be modified to deal with this new world that we live in. What have you seen in with regards to what I just laid out?
So let me step back a bit from the question and answer it in a more holistic way. A big driver of my business is IPOs. We are trying to, if you recall, I am focused on private companies, VC-backed, PE-backed companies. I'm trying to identify future IPO candidates, future public companies, because as a firm, we make money off of that transaction, and then in perpetuity, the recurring revenue from an audit perspective. So that's a big driver of my business. There's, to your point, timing wise, the last couple of years, there's been a real drought on IPOs, and it's affected my business. It's affected a lot of business. But what has happened is there's a lot of companies that were teed up that raised a lot of money in 2021, 22, early 22, and with the intent that they were going to go public in 12 to 24 months after that. And they were spending like drunken sailors. Also, the expectation that they'll be able to raise another big fat round at a multiple of valuations that they had at that last round. Well, that all kind of stopped. And the VCs had a come to Jesus moment and said, look, we're probably not writing you any more checks. So you better make do with what you have. And you do that by cutting costs and by reaching for profitability. A lot of companies were in that state and were already starting that process of IPO because that was kind of the next funding option for them. And they were acting like a public company. So we're close. It used to be the bar was 100 million in revenue. That bar has now gone up to 400 or 500 million. Is kind of the investment banker commentary on that. But back in the day, it was 100 million. You hit 100 million, you could start planning. You start doing your org meeting and start planning for your IPO. And a lot of companies were in that mode. And part of that from our business was acting like a public company, which means PCAOB audits and quarterly filings and all those things. Well, there's companies that have been doing that now for 2 to 3 years. And they've been spending a lot of money for lawyers and accountants to get there. You can't turn it off. Once you turn it off, it's a big ramp up to turn it back on. So they've been just continuing down that track. And so I consider that pent up supply of IPO candidates. So they've been waiting for this election to happen because we didn't know what was going to happen there. Now it happened. So what's the present in the future? I expected by now we'd hear about a bunch of companies that have filed confidentially, the old air quotes, to go public. And we have not heard that many. There's a couple here and there, but not the torrent that I was expecting and honestly hoping for. I think Q2 will be better, but I think a lot of companies are really waiting for some of the big guys to go out. I say big guys, the high valuation private companies, Databricks, Stripe, Klarna, SpaceX, one of those big boys with 40 billion plus in valuation to go out, have a great first day, big spike day one, great first quarterly earnings announcement. And then I think the doors are going to open and a bunch of other companies that maybe are not in that bucket, that high end bucket, but next tier down, they're going to start going out. I don't know if any of the big guys, just to finish the thought, those big guys have all made plans to take care of their people, their stakeholders that but wanted that transaction to happen so that they can get some liquidity. They've done secondaries to give liquidity to their early employees, to their early investors. So there hasn't been as much of a need. You listen to Stripe talk about like, oh yeah, go public. Maybe. I don't even know if we're going to do it. So that's an interesting phenomenon that's going on. And sorry I interrupted you, Rich.
Oh no, I interrupted you. It's just I have a theory on that, and that is that as we know, as interest rates drop, valuations generally will increase, and because of discounted cash flow analysis, et cetera, and so it's basically the future value of money. And so if we do have lower interest rates, that will help the IPO market because the valuations of these companies will go up. And towards the end of last year, we saw higher levels of inflation, which I think spooked people in the bond market. And then there were a lot of financial analysts on the news programs that I think mischaracterize the tariffs as being a blanket tariff on every country starting from day one, which would be highly inflationary instead of targeted tariffs used to achieve certain ends. Uh, so I think there was probably in the mind of the markets that there would be higher inflation levels, and that is going to mean higher interest rate, which means less likely a need to go public now. You wait till the rates come down, and then what we've seen just in the last couple of days with the freezing of spending, and we've seen also the voluntary or the buyouts of government workers, that there's now a serious move to cut spending and to cut it quickly, which could be deflationary to some degree, and then the interest rates theoretically will come down after that. Also, lower fuel costs. So that's kind of
So
how I.
you think the federal move, like the move to say you can quit now and get paid to September, you think that is going to have a driving force on the economy?
So 5 to 10%. I don't think it has an effect on the economy. It has an effect on the psyche. If you remember, and we go back, you and I were around during the Bill Clinton presidency. He's the last president in my lifetime. That when the nation was in a recession, he said the government shouldn't be spending when the nation's in recession. We're going to lay off 5% of the government workforce. And that, coupled with the internet and a lot of other things that happened at that time, it really helped. It spurred the economy. I think it gave confidence in the U.S. economy, the U.S. governing system. I think when the government gives up the value of, or gives up those workers, and they get deployed to the private sector, it helps it. It spurs the economy. It increases productivity. As Elon Musk put it, these workers that are in the government, they're working in an inefficient operating system, and so their productivity is limited. Whereas when they go into the private sector, maybe they start companies or they work for startups, and they become much more productive. The economy becomes more productive, and that helps grow the GDP. And hopefully, I mean, that could have an inflationary impact. But if all these other things work properly, right, with lower fuel costs, with government not having to print $1 trillion plus in interest every year, which is also inflationary, right? Those are positive moves for inflation. And then when that happens, the next step is, I think Trump is going to apply pressure on the head of the Fed to lower interest rates, maybe ahead of when they might normally want to do it. Whether that's good or bad is another, could be another discussion, but it's going to happen. So we'll probably have lower interest rates, lower fuel costs. Then the IPOs theoretically will have, assuming there are no external shocks to the system.
So I agree with you in theory. The concern with a blanket move like they did yesterday or today, where they said 2 million people, I think it's 2 million federal workers, will pay you for 7 months if you put in your resignation by the end of the week. The risk is all the best people in government say, oh, well, I'm going to take that severance and I'm going to go and get a private sector job and get paid 2x, 3x. Those are the people that may leave, or all the top end. And the people that are at the lower end that have been bureaucrats their whole lives, they're going to say, well, I'm going to wait this out and hopefully save my job. So potentially the government's going to get less efficient because we lose all the best talent and all the lesser talent sticks around to run the government. Just a thought.
No, it's a good thought. But again, I think that the challenge in the government is, it's not just government, right? I use government as just a placeholder for any huge organization. If you're working for a large multinational that has 50,000 employees, it's the same. You can only accomplish so much given the system that's in place when you have 50,000 people working for the same organization, or whatever the number is. Once you get to a certain point, there's only so much you can accomplish, which means those really super talented people, if they're not fed up already and having gone to the private sector, especially if they can make more money, they're probably gone and already. But yeah, there are going to be some good ones that will lose, without a doubt. But that's, it's like any other company, right? If you have layoffs or you do something like this, some of the good people are going to go. You can always rehire people down the road. But I think we've gone one way, and now we've got to come down, and then things will level out over time, hopefully.
Agreed.
Right. So, final question. This has been great. I really appreciate your time. How do you see the VC ecosystem evolving as we go into this new environment with at least stabilized interest rates, right? At least they're not going up; they're stabilized, and things are things are kind of somewhat certain day to day, and we're not seeing increases. And if you're an entrepreneur, where would you be prioritizing your time, your efforts, your energy?
Um, Whenever I talk to an entrepreneur and they tell me I'm going to raise a round in 6 months, in 9 months, I tell them start now. Um, it's so hard to raise money these days. You have to have a track record. You have to have a clear idea on the industry you're going after. There has to be a clear addressable market for what you're doing, and it has to be a real differentiator as far as the tech that you're bringing to the table. VCs are very skeptical. You really got to prove it. And with the stuff we went through with FTX a couple of years ago, a lot of people got burned with that, and
Yeah.
so their due diligence is 2x, 3x what it was back then. So entrepreneurs really got to have their game face on, and it's going to take a lot longer. There's going to be a lot more reference checks, a lot more proof of what you're doing in order for you to get a check. And I think valuations are starting to go back up, but still, we peaked out a couple of years ago as a broad swath of valuations. So you have to have a reality on what your company's worth. I talk to entrepreneurs all the time, and they're like, "Well, I don't like the valuation that I'm getting from the VCs I'm talking to." And my canned response is, "Well, 100% of zero is still zero. So you might want to just suck it up and take the money if they have some interest. And maybe it's some dilution, more dilution than you wanted in your position, but it's better than the opposite." So that's kind of the message to entrepreneurs and with the VC space in general.
Jules, thank you so much. You've been really, really generous with your time. I want to make sure to just give one more plug to this great report that your company put out. Everyone should go to kpmg.com and check out this Q4 24 Venture Pulse report. And I just want to thank you very much. And hopefully we can have you back on the program in the future. And, the way tech is moving, we literally need to make this a daily show, because I could ask you another like 20 questions tomorrow, just because by then we're going to have like 5 more AI models. God knows what else is going to happen in the market, right?
It's a fun time to be in this industry. I'll tell you that. Definitely keeps me excited about the next day every evening. So thank you for the opportunity, Rich. Great to see you. Great excuse to connect with you, and look forward to next time.
Take care.